We're analyzing Nvidia's stock ticker NVDA to see if it's a great business on sale. We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for Nvidia. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing Nvidia for your stock portfolio. Before we get into these valuable metrics, let's understand Nvidia's stock performance. Right now, Nvidia trades for $430.22 per share. Nvidia's beat the market by a ton year to date. Their stock price has more than doubled. This crushes nearly every other stock out there. In the last 5 years, Nvidia's stock price is up nearly 7 times. They're compounding at 49% annually. In the last 10 years, Nvidia's doing even better. They're compounding at 61% annually. In the last 10 years alone, Nvidia's stock price is up 120 times. It's safe to say Nvidia is one of, if not the best performing stock in the last decade. Going back prior to the global financial crisis, Nvidia is crushing it. Their stock is compounding at 33% annually. Nvidia's performed so well recently, their stock chart looks like it doesn't start until July of 2016. This shows Nvidia's recent meteoric rise. They also pay very small dividends. Right now, Nvidia has a 0.04% dividend yield. Right now, Nvidia trades $10 below their 52-week high. The company is up more than $320 from their 52-week low. Nvidia is valued as a huge business. They have a $1 trillion market cap. But the burning question is, why has Nvidia's stock performed so well recently? Nvidia is the top designer of discrete graphics processing units that enhance the experience on computing platforms. The firm's chips are used in a variety of end markets, including PC gaming and data centers. In recent years, the firm has broadened its focus from traditional PC graphics applications, such as gaming, to more complex and favorable opportunities, including artificial intelligence and autonomous driving, which leverage the high-performance capabilities of the firm's products. With the recent hype around AI, Nvidia's stock has done insanely well. It's Nvidia's GPUs underlying many AI applications. With this background of the business, it's time to get into the numbers. Starting with metric number 1, we want Nvidia's average return on capital in the last 5 years to be above 14%. The typical business earns about a 7% return on capital. Looking for a benchmark that's double this allows us to build in margin of safety based off the quality of the business. Nvidia's returns on capital have been above average in all 5 of these years, but surprisingly, they've been declining. They were as high as 33.5% in 2019. In their last fiscal year, they hit their lows over this time of just over 16%. When we average this out, Nvidia earns 23% returns on capital in a given year. That's still 3 times above a typical business, so this is a big check on metric number 1. You want to be mindful these returns have declined. Semiconductors are a cyclical industry. Metric number 2, we're looking for growth to support their high returns on capital. We want to see growth in their revenues, net incomes, and free cash flows up until today. All 3 of these need to be up for this to be a check. This is all or nothing. During this time, Nvidia's grown their revenues 2.5 times. Their earnings are up just 16%, and the company's free cash flows have grown by 62%. This is growth across the board here, meaning this is a check on metric number 2. Something to call out and be aware of, the company's trading at more than a 40 times price to sales ratio. That's extremely high for any business, something you absolutely want to keep in mind for this business. Metric number 3, we're looking at Nvidia from the view of an individual shareholder. We want to see earnings per share growth in the last 5 years. As we learned, Nvidia's earnings have grown by 16%, and the company has bought back just a fractional amount of shares during this time, which is better than them diluting shareholders. Because of these tiny share buybacks and the small earnings growth, this is a check here on metric number 3. Nvidia's grown their earnings per share. Metric number 4, we're looking for free cash flow per share growth in the last 5 years. A similar story here, because of their 62% free cash flow growth and these tiny share buybacks. This is a check on metric number 4. Recapping where we stand currently, Nvidia's perfect. They're 4 for 4 on our analysis. But there's still one vital piece missing. You might think nailing returns on capital and having good growth is the key, but we haven't touched on the one thing that I believe sets Nvidia apart, which is having these characteristics without using a lot of debt. In metric number 5, we want Nvidia's net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow they produced in their last 5 years. Nvidia has had negative net debt in all 5 of these years, meaning they're left over with cash and equivalents after paying off their debt. Right now, they have about $3 billion in cash. They They've also produced positive free cash flows in all 5 years that have been growing over this time. When this is summed up, Nvidia's produced $24 billion of free cash flow, meaning this is a check here on metric number 5. Nvidia has a cash cushion on their balance sheet, and they're strongly cash flow generative. We're still perfect through 5 metrics. Does Nvidia have what it takes to be a perfect Select 6 stock? We'll find out, but first, it's time for our bonus. As our bonus, we're looking at Nvidia's dividend profile. Right now, Nvidia pays a very small 0.04% dividend yield. Surprisingly, the company's kept this the same since 2020. They have not been increasing their dividends over this time, even as their free cash flows have grown. Nvidia supported their dividends using their cash flows pretty easily in all 5 of these years, and that's the case today. In both the past and today, they have a very low dividend payout ratio. The big metric of them all, metric number 6, we want Nvidia's average 5-year free cash flows divided by their total enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we'll be estimating a fair value for Nvidia. Right now, Nvidia has over $1 trillion market cap. They're valued as one of the largest businesses in the world. From their 52-week lows in October of 2022, Nvidia's market cap and enterprise value have more than quadrupled. We learned in the last 5 years, Nvidia's produced $24 billion of free cash flow, meaning in an average year, they produce $4.8 billion of free cash flow. When that's divided by their $1 trillion enterprise value, we get a tiny 0.48% average free cash flow to enterprise value yield. On a current basis, Nvidia's produced $5.1 billion of free cash flow in their last 12 months. When that's divided by their $1 trillion enterprise value, we get another very small 0.51% current free cash flow to enterprise value yield. Both of those are a lot lower than the yield of the 10-year treasury, meaning coming in all the way at the end here, this is our first and only X of the day on Nvidia, but don't just throw this business out. We want to come to a more concrete estimate of Nvidia's fair value per share. Everything we've discussed so far is important, but there's something missing that, in my opinion, is the main reason to analyze Nvidia, which takes us on to using a discounted cash flow model to come to an estimate of their fair value per share. A DCF model is based off the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. Nvidia's been a pretty predictable business in its past. We're starting with an average of their last 3 fiscal years worth of free cash flow, then using historical assumptions to grow these into the future. It's up to you to figure out if these are accurate or not. Assuming Nvidia grows their 3-year free cash flows at a rate of 24% annually for the next 10 years, then in the decade from there, they'd be growing these at 12% annually, so that growth rate is cut in half. If we add in the company's tangible book value, which gives an estimate of their net worth, if we're seeking a 15% rate of return, which is the rate of return Warren Buffett's looking for in addition to his margin of safety requirements. From today's valuations of Nvidia, based off their cash flows, an estimate of their fair value per share is only around $82. That's down a lot from their current stock price, which doesn't look like there's a margin of safety in the business. There are key points to be mindful of. Nvidia has had a high degree of business predictability in their past. Even with these growth assumptions, which are pretty generous, Nvidia looks to be a long ways off from their current stock price. It would take quite a lot of growth just for this business to trade sideways in the next coming decades. Remember, this is an estimate. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with a financial advisor before making any investment decision. In just a minute, we'll talk about our final rating for Nvidia, but we have to address something first. We've covered the numbers, but the qualitative aspects of this business are just as important. What are they? Looking at the factors supporting a potential long thesis, number 1, the increasing complexity of graphics processors provides a barrier to entry for most potential rivals, as it would be difficult to match Nvidia's large R&D budget. Number 2, the firm has a first mover advantage in the autonomous driving market that could lead to widespread adoption of its Drive PX self-driving platform. Number 3, the proliferation of AI and deep learning that rely on Nvidia's graphic chips presents the firm with a massive growth opportunity. We'd be remiss if we didn't cover the negatives of the business as well, looking at the factors supporting a potential short thesis. Number 1, a large portion of sales come from the maturing PC industry via PC gaming. Number 2, Nvidia's automotive endeavors face plenty of competition as numerous chip makers are targeting the market. Number 3, the artificial intelligence opportunity remains nascent, and it's not a foregone conclusion that Nvidia's GPUs will dominate. There you have it. it, for a balanced perspective of the qualitative factors for the business. Now it's time to give our rating. In analyzing Nvidia Corporation, stock ticker NVDA, Nvidia has the makings of a great business. They earn high returns on capital, they've had strong growth, they don't use a lot of debt, and they're cash flow generative. It's worth reiterating this analysis isn't financial advice. It looks like Nvidia has sky-high valuations on what's otherwise a good business. Their free cash flow to enterprise value yields did not look attractive compared to the yield of the 10-year treasury. While Nvidia supported their dividends, they haven't grown this as their returns on capital have declined. When we performed our discounted cash flow analysis from today's valuations using those assumptions, if you're seeking a 15% rate of return, an estimate for Nvidia's fair value per share is around $82. That's down nearly 4 times from their current stock price. Nvidia last traded at those levels in May of 2020. Looking at all the factors of our analysis, Nvidia looks like a weak candidate for further research. Don't let that discourage you if you're interested. This is not a buy or sell recommendation of any security. It's not financial advice. If you enjoyed today's video, be sure to like the video, subscribe to the channel for more stock analysis videos, share your thoughts about Nvidia, and let me know what business you want me to look at next in the comments below. Thanks for learning about Nvidia with me, a high-flying popular stock, and have a great day.